Hello again. Chapter 6. We're going to do two videos again, one for the lecture and one for the homework. But this is going to be relatively short, I believe. Okay, so in terms of the topics, learning objectives, we're going to cover 1, 2, 3, and 4. We're going to take some of the concepts that we learned in chapter 5, and we're going to put them to work. If you remember in chapter 5, we learned about contribution margin. Selling price minus variable cost is contribution margin. And we can express that in a dollar amount, a per unit amount, and a percentage, if you recall. So in this chapter, we're actually going to take that concept of contribution margin and put it to work. So if you look at the first learning objective, use cost volume profit analysis to find the break-even point. We're going to figure out, what does the company need to sell to break even? Units or dollars, right? Both. We're going to figure out both. Can we determine the sales needed to achieve a target profit? So, it's not really good business just to try to break even, but if we have a targeted profit, what will we need to sell to achieve that target profit? Margin of safety, which is kind of a related concept, and analyze how changes in prices and cost structure affect cost volume profit analysis. In other words, what if we change some of the variables? Okay, so cost volume profit analysis helps us determine the volume of business that we need in order to break even or achieve a targeted profit or to hit that margin of safety. How many customers do I need? What's the dollar amount in sales that I need, etc. Now, there are a few different ways to do this. As usual, I'm going to try to take the most basic approach. I don't like graphs as a rule, so we're not going to pay much attention to that. This is what we're going to do. Okay. So sales minus variable costs minus fixed costs equals profit. We are not going to use algebra, right? There's an algebraic way of doing this. We're going to use the contribution margin method to do this. Now, remember in the last chapter, we saw this illustration using the Starbucks example. Sales is $2.50 per cup of coffee. The variable costs were $1. The contribution margin is $1.50. And if our fixed costs are $12,000, what do we need to break even, right? Break even means where your net income is zero. Right? Here's the formula to do that. Contribution, break-even point in units. Break-even point in units. In other words, in the Starbucks example, how many cups of coffee must I sell in order to break even? Fixed costs divided by unit contribution margin. So in this example, total fixed costs were $12,000 divided by $1.50 was the contribution margin for 1 cup of coffee, remember? That gives you 8,000 units. You would have to sell 8,000 cups of coffee at $2.50 a piece in order to break even. Now, what about target profit? What if we took the same example and we decided that we wanted to make a profit of $18,000? $18,000 profit. Formula is almost the same. Take the fixed costs and add the profit divided by the unit contribution margin. So in our example, the fixed costs were $12,000. The target profit was $18,000. That's a total of $30,000. Divided by $1.50, 20,000 units. We would have to sell 20,000 cups of coffee at a price of $2.50 to hit that profit of $18,000. And here they're showing you how you would do that. $2.50 times 20,000 units is total sales of 50,000. The variable cost, $1 for a cup of coffee times 20,000 cups, $20,000. That gives you a contribution margin. 50,000 minus 20,000 is 30,000. Or you could calculate it, right? The contribution margin per cup of coffee is $1.50 times 20,000 cups, $30,000. 30,000 minus fixed costs of 12 gives you net income of 18,000. Right now, these illustrations we looked at were using unit contribution margin, right? But that's what the topic is, unit contribution margin method. Contribution margin per unit. Right now, here we're going to use, instead of that, we're going to use the contribution margin ratio method. You should know how to do it both ways, because depending on the problem they give you, you may have to use one method versus the other. You know, sometimes when you do these accounting problems, they don't always give you all the information that you would like to have. So in this particular example, what was the contribution margin ratio or contribution margin percentage? If you recall, it was 60%. And how do we get to 60%? We take the $1.50 and divide it by $2.50. So we take the contribution margin per unit divided by the sales price per unit, and that gives us 60%, 0.6 or 60%. So in terms of the break-even analysis, if we take the total fixed costs and divide it by that contribution margin percentage, 12,000 divided by 60%, $20,000. So what does go back to the unit contribution margin. What does the unit contribution margin method do? It tells us how many units we need to break even, right? This method is telling us we need 8,000 cups of coffee to break even. And what this method is saying, we need $20,000 in sales to break even. Now, you know, if you took the first example, 8,000 cups times $2.50, you would come out to the same 20,000. But remember what I said earlier. Sometimes you don't know. Sometimes they won't tell you everything, and you'll have to use one method or the other to get your answers. The same for the target profit. We take the fixed cost, add the target profit, 12 plus 18, 30,000, divided by 60%, 50,000. Margin of safety. What is the margin of safety? It's the difference between the actual sales and the break-even point. The difference between the actual sales or budgeted sales, if that's what they give you, and the break-even point. So actual or budgeted sales minus break-even sales is margin of safety. So in this particular example, the Starbucks example, if the actual sales were 37,500 and the break-even sales were 20,000, which we computed earlier, the margin of safety is 17,500. Okay, now here what they do, and we have to see when we get to the homework to see how this really works. I believe one of the homework problems is going to ask us to do this. What if we change things, you know? For example, this is what we have right now. We're selling the coffee for $2.50 a cup, and the variable costs are $1. The contribution margin is $1.50. But what if we were to raise the selling price to $4 a cup? And if the variable cost stayed the same, now the contribution margin is $3. Right? So, you know, how many cups of coffee would we have to sell, right? Or what's the dollar volume in sales that we'd have to have in order to hit certain targets? So in this particular case now, the contribution margin percentage comes out to 75%. Here it was 60%. So what would we need to hit a target profit of $10,500? 12,000 plus 10,500, which is 22,500, times divided by 75% is $30,000. On a per unit basis, I take the 12,000 plus 10,500 divided by the $3 contribution margin. I have to sell 7,500 cups of coffee. Right? Now, what if we change something else? You know, you can change a lot of different things here. You could change the costs. You could change the selling prices. So, you know, we just have to be able to go back and substitute numbers in these formulas to do what they're asking, right? And again, the math is pretty simple. I think when you read the book, they actually make it harder than it has to be. But in the next video, you'll see we're going to do the homework. We're not going this far. Right? So this video wasn't too long. The next video will go over the homework from this chapter.